YouTube, the five best stocks for covered calls. Now, I appreciate you guys for tuning in. Please hit the like button so we can grow the channel and fight the algorithm. I would appreciate it. Number five on the list, no other than Microsoft. You can see it on the screen. The reason why we went with Microsoft is because Microsoft is one of the best stocks in the world, and you get a nice premium when you run covered calls on them. Now, before we dive deep into this, I would say this. So, we're going to give you guys some of the big boy blue chip stocks, but then we're going to show you guys cheaper routes you can go if this going to be too expensive for you. So, for those of you that don't know, for covered calls, for example, let's say I own 100 shares of Microsoft, which would essentially cost me a little more than $40,000, right? But I'm gonna show you guys cheaper routes. Don't worry. Now, what we're essentially saying is, since Microsoft is sitting at $404 right now, and let's say we're going to sell covered calls, right? So we would do sell, okay, and then we would go out. Let's say we don't see Microsoft going past $415 over the next 3 days. So what we would do is click on 415, okay, the 415 strike price, which essentially it shows us we've got an 85.79% chance of profit. Now let's explain what that means. So what that means is if Microsoft goes above $415 by the expiration date, then I will be forced to call if I held the option for that long. Essentially, what that means is I would have to sell Microsoft at whatever price, strike price it would be at expiration. So if Microsoft is at $420, guess what? I will be forced to sell those shares at 420, and then obviously you're going to be a little negative from your profits just because of that premium. Okay. Now, a cheaper option for this would be if you don't own 100 shares of Microsoft, then you would have to control 100 shares. So here's how you control 100 shares. So if you want to control 100 shares, what you would do is go out a year or more. So, okay, so this is called a leap year option contract. Okay, so let's say we went with August 15, 2025. So if I want to control 100 shares, I would have to go nicely in the money. So I would come down to, like, let's say, I don't know, 390. Okay. And so instead of it costing me $4,000, it would only cost me $6,000 to control 100 shares. Okay. And then once I've done that, then I could go in and then I can sell the call, let's say a week or so out against this leap year contract that I have. Hopefully that makes sense. So then I will come in and say, I don't think Microsoft is going past $410. If it doesn't go past $410 by this expiration date, I collect $460, which you see. But if it goes above that, then I will be forced to sell my shares if I held the contract at expiration. Okay, so that's essentially what that's saying. Now, let's say that $6,000 is too much, right? Then you could do something which is more risky, but it's going to cost you less. So you basically would be playing the movement of Microsoft. And so this is one way you could do it. Like I said, this is a 2x ETF. So basically, it moves two times the percentage of what the basic Microsoft uh, sh- uh, shares would move. Okay, so let's say, for example, if Microsoft is up 2.2% right now, you can see it's double here at 4.4%. Okay, so that's all that's saying. Now, if you want to be a little bit more risky but use less capital, this is a route you can do, and you can control 100 shares of this. But if you want to go cheaper and you go to trade options, you would do a leap year contract just like we showed you. So you could do something like January 2025, for example. I think that this will be considered a leap option on this brokerage. So let's say I want to be all the way in the money, buy a call here at $34, which would essentially cost me $990. Okay. And so now you guys are starting to see these different options that you guys can choose. Okay. So again, Microsoft is number 5 on the list. Now, number 4 is going to be, let me type it in for you guys, Nvidia. Okay. And Nvidia is, a part of the Magnificent Seven. They've made so much money over the past couple of years. It's not even funny. Now, the reason why we chose this one is because it's in the top 3 of biggest market caps, and it's a company that's not going anywhere. They have the capital to allocate to many different industries and continue to grow by investing in other companies or buying companies out or whatever it is they want to do, they can do that. So if we go to trade options here, you can see how high the premiums are for Nvidia. Okay, so if we do sell a call, for example, okay, let's say we don't see Nvidia going past, and this is that, let's say you have 100 shares, right? You got 100 shares of Nvidia, and you can run this cover call. You saying, okay, by August 9th, I don't see Nvidia going past $115. If it doesn't, I collect $64. If it does, then I will be called out, meaning I will be forced to sell my shares if I do not close my position and the strike price is above $115 by August 9th. Okay. So that's essentially what that's saying. And now you don't have to go 3 days out. I know we're in the middle of the week. You can go out to August 16th, which is 10 days away, and you can get a bigger premium at that same strike price, or you can go up a little higher. So let's say by August 16th, I don't see Nvidia going past $119.50. Essentially, I would collect that $100 if it doesn't do that. If it goes above, you guys tell me what happens after that. Now, another option you guys can do, if that's too much, we talked about the leap year options. Do you have that as an option? We showed you that with the Microsoft. And then you can do NVDL, I think is one that tracks the movement of NVIDIA, which is more risky because it doubles the movement as far as percentage for NVIDIA. But this is just a cheaper route that you guys could go if you're willing to take on a risk like that. Now, I'm not much of a trader per se. Um, I will do, some options trading every now and then, and I may, uh, do some scalping with, these 2X ETFs from time to time, especially as the markets have fallen, then I'll go in and get some of these types of ETFs. But in a nutshell, I'm just giving you guys some ideas. Now, most of the, I think all of the Magnificent Seven have some sort of 2X ETF. So I would look into those if you want to be a little bit more aggressive. But for a lot of people, the risk is just not worth the reward for them. But for me, I know what I'm doing, so I'm a little bit more risky with these 2X ETFs every now and then. This is not an all the time thing. Now, number 3 on the list is going to be Apple. Company. It's not going anywhere. It's powerful. It's got a lot of capital. Everybody loves Apple for the most part. Well, let me rephrase that. Everybody does not like Apple. I think a lot of investors like Apple as far as investing in the company. Okay. Now, same thing here. You would go to trade options in your Robinhood account or whatever brokerage you're using, and then you would just, go ahead and look at what kind of contracts they have. Okay. So let's say in the next 3 days, you say Apple's not going above 215. that could be risky because we could be going back to the upside. And let's say if you went with 215, you can make $91 if Apple does not uh, go above 215 by August the 9th. Okay. And another option you guys have, you can do that leap year contract, or you can do AAPU, which is another 2x ETF that tracks the movement of Apple, and it amplifies it by 2 as far as percentage. Okay, so you can see that here. We've already explained that. All right, next on the list, we've got, and I'm gonna go for QQQs, guy. QQQ is a good one. Um, I'm trying to let it load up here. So QQQ is a good one. It's number 2 on our list. Essentially, is very heavy weighted with technology, and this tracks the Nasdaq for those you got. So for those of you guys that don't know, and so you can see some of the heavier names are Apple, Microsoft, Nvidia, Amazon, Broadcom, Meta, Tesla, Alphabet, so forth and so on. So if you don't want to pick individual stocks, this is what I would recommend. Can't tell you guys what to do, but I just recommend it if you don't want to play those games with the stocks outright. Now, another one you can use for this one could be TQQQ, which I'm gonna type it in here. I'm not gonna actually go to it, but TQQQ is a triple ETF for the Nasdaq. So if you want to be a little bit more, you want to take on a little bit more risk, that could also be an option. So I'm gonna go over this one more time. Let's say you don't have uh, $40,000. Okay, what you can do is you can do a leap year option contract on this as well. Okay, so you can go a year or more out. Let's say we wanted to go for December to give us a little bit more wiggle room. Okay, and now what we can do is go deep in the money. Okay, let's say we would decide to go with 424, for example. What you're now saying is I'm willing to use $7,000 instead of $40,000. So in a leap year contract, you're saying I'm going to use $7,000 to control 100 shares instead of just buying 100 shares outright. Okay. And then once I've gotten my leap year, I go in, I can hit review, accept, and then I will come right back in here. I will sell a call, a week or two out. Let's say we want to go 2 weeks out for this example. And then I say, you know what, the market has been kind of, bearish lately. I don't see QQQ going above 460. So again, you guys know what happens now. If it doesn't go past that, I collect $400 in 2 weeks. If it does go past, then guess what? You guys already know what's going to happen from there. So that's number 2. And then number 3 on the list is going to be the SPY. Okay, the SPY is another safe ETF you guys can use. A little bit expensive. As an option, you can do something like a U Pro, or something else that tracks the S&P 500 that could be a little cheaper for you. You could do something like SPLG. So I'll type SPLG in here. So this is another ETF that tracks the S&P 500, and then you guys know what to do for there. Now, as a bonus, guys, I promise you that I'll give you 2 if you just only have a couple $100. So one that I like to do is SoFi. So SoFi is one that I like to use. Actually, just did this yesterday with SoFi, made a nice amount of money. And then you got another stock like Rivian is a good one you can run this on. Um, and of course, you guys, if you want to take on more risk, there are stocks like Neo and SoundHound AI. I mean, there's a lot of different stocks out there that you guys can add to your list. Okay, So overall, in a nutshell, guys, essentially the initial five were the five best, I would say, because these stocks aren't going anywhere. I don't see now any stock can drop at any given time, but for me, I would only mostly run these strategies on companies that I truly believe in. And if you believe in a stock like Bank of America, Wells Fargo, Chase, Google, Amazon, they all have pretty nice premiums as it pertains to covered calls. So I, I would only do this on stocks that I actually want, right? So if you have these stocks or you want them, this is a good strategy. You can continue to make money off of these stocks over and over again. So yeah, guys, that's what I got for you guys. I appreciate you guys. Please hit that thumbs up, guys, so we can continue to grow the channel. I would appreciate it, and I'm out. Peace.